Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward.
It is really the only way to invest. The market loves a good story, a good narrative. But if you don't understand the downside, the trap doors, the hidden leverage, the structural decline, you aren't really investing.
You're just gambling.
You're gambling, and we don't gamble here.
We certainly don't. We are investigators, and today we are opening a case file on, well, perhaps the most iconic, the most beloved, and I think it's fair to say the most controversial asset in the history of entertainment.
That's a big claim, but I think it fits.
It's Monday, February 2nd, 2026.
And it is a very, very significant Monday for this company.
Huge. The Walt Disney Company has just dropped its Q1 fiscal 2026 earnings report this morning. And if you have been watching the ticker or just scrolling through any financial news feed, you know the market is awake.
Oh, it's definitely awake. The volume is high. The numbers are big.
They are big, and this is the core of our deep dive today. The numbers themselves, they're just the scorecard.
Exactly. The real story, the thing we care about, is the strategy shift underneath those numbers. It's a fundamental change in the DNA of the company.
And that's what we're here to unpack. Because if you've been following Disney for, say, the last 5 years, you know the narrative has been, let's call it messy.
Messy is a polite way to put it. I'd say chaotic. You had the pandemic shutdowns, which were an existential threat to their biggest profit center.
Right. The parks were just closed.
Then you had the Bob Chapek era, the controversial return of Bob Iger, the very public, very nasty boardroom battles with Nelson Peltz and Treon.
And through all of that, the absolute bloodbath that was the streaming wars.
A war of attrition? The strategy was effectively growth at all costs. It was just spend, 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 burn whatever cash you have, just get the subscribers on platform.
Forget profit, just get the number up.
Forget profit completely. It was a land grab.
But looking at this report today, on February 2nd, 2026, the thesis, the entire mission statement, seems to have fundamentally pivoted.
It has. It's a complete 180.
Yeah.
The era of chasing subscribers with a blank checkbook is officially, definitively dead.
So what is the new era, if you had to put a label on it?
I'd say it's about becoming a high-margin, technology-integrated entertainment fortress. It's a hard pivot to profitability, a doubling down on physical experiences, and leveraging technology to finally stop the bleeding in content costs.
Okay. So our mission for this deep dive is clear. We're going to dissect these Q1 2026 earnings. We're going to look at this massive, and I mean massive, $60 billion expansion plan for the parks.
$60 billion. It's a staggering number.
We have to talk about the evolution of sports with the NFL partnership. And crucially, we need to talk about this wild AI bet they've made with OpenAI.
It could be a game changer, or it could be a massive distraction.
Right. And at the end, we need to determine if the magic is financially restored.
Or if it's just, it's some financial engineering. Smoke and mirrors designed to pump the stock.
Let's find out. So let's start where we always do on Griffonomics. Section 1, the business model. Before we get into the shiny new toys, the AI, the new lands, we need to understand the machine. When we say Disney in 2026, what are we actually looking at?
It's the single most important question to ask, because the public perception of Disney, Mickey Mouse, movies, the magic, is very, very different from the financial reality of the company.
The story versus the balance sheet?
Exactly. If you strip away the pixie dust and just look at the breakdown from this morning's 10Q filing, and you cross-reference it with the structural data we've been tracking, Disney has really three distinct and very different engines.
Okay, let's break them down one by one. Engine number 1.
Engine 1 is entertainment. This is the face of the company. This is what you see on the billboards, what your kids are watching.
Yeah.
It's the film and TV studios, Marvel, Pixar, Lucasfilm with Star Wars, 20th Century Studios.
The content factory.
Right. It also includes the linear networks, what's left of them anyway, the legacy TV channels like ABC, FX, National Geographic, and critically, it includes the direct-to-consumer streaming business. That's Disney Plus and Hulu.
So all the stuff we watch on screens, pretty straightforward.
It seems straightforward. But here is the financial reality check that usually surprises people. Historically, and even looking at the trailing data leading into 2026, this entire segment generates about 45% of the total company revenue.
Okay, so almost half the money coming in the door. That sounds pretty good.
It does. But historically, it generates only about 11% of the EBIT.
Whoa, stop there. I want to make sure the listener really grabs that. You're saying nearly half the revenue brings in just over a tenth of the actual profit.
That is the fundamental trap of the modern media business. And just to define our terms here, EBIT is earnings before interest and taxes. It's a clean way to look at operating profit, the actual cash the business engine throws off after paying for everything. The lights, the cameras, the actors, the marketing, all of it.
So why is the margin so low?
Because it costs a tremendous amount of money to make the magic. It is incredibly capital intensive. Think about a Marvel movie. You have to pay Robert Downey Jr. his $20 million quote. You have to pay hundreds of VFX houses.
And then you have to market it.
You have to spend maybe $150 million just to market the movie globally. It is a high-burn, low-margin business, especially when you are in the middle of this painful transition from the old high-margin cable model to the much lower-margin streaming model.
Okay, so entertainment is the sizzle, but not the steak. It's almost a loss leader, or at least a low-margin leader. It brings people into the ecosystem, but it doesn't keep the lights on by itself.
Not even close. It's the front porch of the Disney house.
Okay. What's engine number 2?
Engine 2 is sports. This is the empire built around ESPN and ESPN Plus stocks. In terms of the business mix, it's pretty balanced. It sits at roughly 19% of the company's revenue and, coincidentally, about 19% of the EBIT.
So it punches its weight?
It punches its weight. It's the reliable utility. It's steady. Sports are live. You can't binge watch them later, so people stay subscribed. It's the subscription you keep because you need to watch the game.
It's historically been a cash cow.
A huge cash cow, though, as we'll discuss later, that cow is changing its diet pretty dramatically. But then we get to engine 3, and this is the aha moment for most investors when they really look at Disney.
Experiences.
Experiences. This is the theme parks: Disney World, Disneyland, Paris, Shanghai, Tokyo, Hong Kong. It's the Disney Cruise Line. And it's consumer products, the toys, the T-shirts, the lightsabers you buy in the gift shop.
Okay, so what's the disparity here?
It is shocking. This segment brings in about 36 to 38% of the total revenue. So a little over a third, less than the entertainment division.
Okay.
But it accounts for nearly 70% of the total segment operating profit.
70.
7-0.
7-0. Let that sink in.
So if I'm stripping away the mouse ears and just looking at the profit and loss statement, Disney isn't really a movie company.
It's not really a streaming company either.
Not from a profit perspective, no.
Disney is a massive theme park and cruise ship operator that uses $100 million movies as a marketing expense to get people on rides and in gift shops.
That is the flywheel reality. That's the business model in a nutshell. Unlike a pure media player like Netflix, which lives and dies by subscriptions and content hits, Disney is actually a physical experience company.
And for the last decade, and specifically the last 5 years, the profits from the theme parks have effectively subsidized the streaming wars.
They've bankrolled the entire thing. The churros were paying for the Mandalorian.
Literally. Every time someone bought an $8 Mickey pretzel or a $60 Spirit jersey, they were funding the CGI for a Star Wars show.
That's not an exaggeration. And what we are seeing in this Q1 2026 report is them finally realizing that the streaming war has to start paying for itself. The subsidy is ending.
Which brings us perfectly to Section 2, the strategic inflection point. Because for the first time in, well, forever, it looks like that dynamic is shifting. Let's talk about the tech and the streaming numbers, because this is where the pivot becomes real.
It's where the rubber meets the road.
And it started with a bombshell announcement in December 2025, just 2 months ago, that is really starting to roll out now.
The OpenAI partnership.
This was a massive headline, a $1 billion investment.
It was. In December 2025, Disney put $1 billion in equity straight into OpenAI. Plus, they secured warrants for more equity down the line. But the money, as big as it is, isn't the interesting part.
It's the utility, what they're doing with it.
Exactly. This is all about Sora, right? OpenAI's video generation tool.
Correct. It is a 3-year licensing deal for Sora, and this is the critical distinction. This isn't just for the animators in the back room at Pixar to make backgrounds faster. This is facing the consumer.
Explain that. How does a regular Disney Plus subscriber like me interact with OpenAI?
So the rollout, which is happening right now in fiscal year 2026, allows fans and subscribers to generate their own short-form videos, think 30-second clips, using specific Disney IP. Wait, I can make my own Disney movie.
You can make a clip. They've opened up a library of about 250 specific characters. Mickey Mouse, Luke Skywalker, Cinderella, Stitch. You go into a tool on Disney Plus Belly, you type a prompt, something like Mickey Mouse surfing on a cloud of cotton candy or Stitch eating a pizza in space, and Sora generates the video in the Disney animation style.
That sounds incredible, but also dangerous. I mean, the internet is a weird place. What happens when someone tries to make Mickey do something unsavory?
A very valid concern.
Or what if I want to make an Iron Man movie with Robert Downey Jr.? Where does it stop?
And that's where the guardrails and the
Wow.
real business strategy come in. The deal explicitly, and this is the most important part, excludes human faces and human voices.
Okay, so this is the talent protection clause we heard about.
It has to be. You have to remember, the writers and actors strikes of 2023 and 2024. The central fear was AI replacement. So Disney built a very hard fence around this. You cannot generate an AI Robert Downey Jr. You cannot generate a deep fake of a living actor. This is all about protecting those crucial talent relationships.
So it's mostly focused on the animated characters or masked characters like Darth Vader.
Exactly, the classic IP.
Okay, so it's safe. But I still have to ask, why? Why does Disney, the company that prides itself on perfect, polished, curated storytelling, want a bunch of user-generated slop on their platform?
2 words, creative fatigue and cost. Investors, particularly the activists like Trian back in the day, were screaming that Disney was spending too much money to produce content that wasn't sticking.
The content treadmill.
They were on a content treadmill,
Yeah.
spending $200 million on a movie or a show, hoping for a hit, and a lot of them were missing. This OpenAI partnership is about what they call democratizing storytelling. It's a direct move toward user-generated content, or UGC.
Like TikTok or YouTube.
Precisely. Look at those platforms. They don't pay to make the billions of videos on their sites. The users make the videos for free.
And Disney wants a piece of that engagement mechanic.
Desperately. Think about it. If you can get a user to spend 20 minutes on the Disney Plus app creating their own little video, that is 20 minutes of engagement that cost Disney $0 in production.
And they are paying Disney for the privilege of making the content.
Exactly. They're even integrating these tools directly into the Disney Plus interface and have announced a curated slate of the best fan-made AI shorts coming to the service later this fiscal year.
So the users create the engagement for free, which reduces churn.
And it solves the content volume problem. You don't need to film a new, expensive show every week if your users are making thousands of fun, shareable little videos every single day.
That is diabolically smart. It leverages the IP without the production friction.
A massive strategic shift.
Speaking of things paying off, let's look at the direct-to-consumer numbers for Q1 2026. Because I remember a time not that long ago when this division was losing $1 billion a quarter.
It was a cash incinerator. Is an anchor dragging the whole stock down. Anyone who held the stock back then remembers the pain.
Well, the fire is out.
Fire's out, and the ground is starting to look fertile again. In Q1 2026, the direct-to-consumer segment, that's Disney Plus, Hulu, and ESPN Plus combined, swung to a positive $450 million in operating income.
That is a massive swing, from losing billions a year to making nearly $500 million in a single quarter.
It's huge, and the guidance they gave is even more aggressive. The CFO, Hugh Johnston, is targeting a 10% operating margin for the streaming division by the end of this fiscal year.
Okay, let's contextualize that for a minute. Netflix, the market leader, usually operates around what, 20%?
Netflix is in the 20% plus range, so Disney isn't quite at that gold standard yet. But going from massive enterprise-threatening losses to a double-digit margin in just a couple of years is a monumental turnaround in unit economics.
How did they do it? Is it just jacking up the price on everyone?
Price is part of it, for sure. They pushed through some pretty aggressive price hikes. They also cracked down on password sharing, which forced a lot of freeloaders to finally buy their own subscriptions.
Following the Netflix playbook.
Right. But the real strategic driver, the thing that makes the model work, is churn mitigation through what they call the one-app experience.
This is where they finally merged the apps, right? No more jumping between Disney Plus and Hulu?
Yes. If you open the Disney Plus app on your TV today, you see the Hulu tile and the ESPN tile right there. It's all integrated. They are finally, after years of talking about it, mimicking the old cable bundle.
It's a great rebundling of media.
It's the great rebundling. And it works. If you only have a Disney Plus subscription, you might cancel it after you finish the latest season of The Mandalorian. That's high churn, and high churn is expensive.
You have to spend to get that customer back.
Exactly. But if your kid is watching Bluey on the Disney side, your partner is watching The Bear on the Hulu tile, and you're watching SportsCenter on the ESPN tile, and it's all in one app with one bill, you never cancel.
It becomes a utility. Like electricity.
It becomes sticky,
Yeah.
and stickiness reduces your marketing costs to near zero for that customer. That is how you get to a 10% margin.
So they stopped the bleeding and streaming. It's finally a real business. But let's go back to the cash cow, the thing that actually pays all the bills. Section 3. The unit economics of the experience's moat.
This is the fortress. This is the financial core of the entire company. We mentioned earlier that experiences generate 70% of the profit. Now let's look at the Q1 2026 numbers specifically for this segment.
Hit me with the headlines.
It was a record-breaking quarter. The quarterly revenue for experiences cracked $10 billion for the first time in history.
$10 billion in 90 days.
In just 3 months. And the operating income from that revenue hit $3.3 billion. That is up 6% year over year on an already huge number.
That is a lot of churros.
It's an incredible amount of churros.
Yeah.
But here's the really interesting nuance in the data, the thing you have to dig for. Attendance at the domestic parks, so Disney World and Disneyland, was only up 1%.
Wait, hold on. Revenue is at a record, profit is up 6%, but attendance is basically flat. How does that work?
That is the key metric that Wall Street is obsessed with. Per capita spending, or what the industry calls yield.
They are squeezing more money out of every single guest who walks through the gate.
They are optimizing the revenue per guest to an incredible degree. Its ticket prices, yes, those keep going up. But it's mostly the upsells. It's the Genie plus skip-the-line passes, which are pure margin. It's the premium dining experiences. It's the limited edition merchandise drops.
So fewer people, or the same amount of people, are simply emptying their wallets faster and more completely.
Correct. And it's not just in the parks. Look at the hotels on property. Occupancy rates climbed to 87% in 2025, and they're holding strong. This is crucial because we are in an environment with, so-called economic headwinds.
Right. Interest rates are still a conversation. Inflation is still being felt by families.
And yet, people are not cutting their Disney vacation. The demand appears to be incredibly inelastic.
It's the last thing to go in the family budget. You'll cut back on other things before you cancel the trip to Disney World.
It appears so. But it's not without threats. We have to address the giant fire-breathing elephant in Orlando. Universal's Epic Universe, which, since we're in February 2026, opened last summer. So it's been open and operated for about 6 months now.
And it is a beast. Super Nintendo World, the Harry Potter Ministry of Magic, a How to Train Your Dragonland. Tryon, Nelson Peltz, they warned about this. They said Universal was going to eat Disney's lunch.
And that was a completely valid fear. Epic Universe is a compelling, high-quality product. It's the first brand-new theme park gate in Orlando in over 2 decades. And interestingly, in the Q1 call, Disney management did acknowledge international visitation headwinds at the domestic parks.
International visitation headwinds. That sounds like corporate speak for the tourists from the UK and Brazil are going down the street to Universal to see the new thing.
It might be. I mean, it's logical. If you're flying halfway across the world for a once-in-a-lifetime trip, you're going to see the brand new park. But Disney's argument, and the numbers seem to back it up so far, is that their ecosystem is a fortress.
The rising tide lifts all boats.
Sort of.
Yeah.
Their view is, if you come to Orlando for a week to see Epic Universe, you're likely still going to spend a day or two at Magic Kingdom or Epcot.
So Disney doesn't need to win every day of your vacation. They just need to extract the maximum possible value on the days you are there.
Exactly. And with $3.3 billion in quarterly profit, they are doing exactly that. However, and this is key, they aren't just sitting back and letting Universal build all the cool new stuff. They know they need to defend the moat.
Which leads us directly to Section 4, the expansion. The spending.
The turbocharge plan, as Iger calls it.
This is the number that scares some of the more conservative investors. $60 billion.
$60 billion with a B over 10 years in capital expenditures, or CapEx.
That is a staggering amount of money. For context, that's the entire GDP of a small country. Where is it all going? Is it just maintenance? Painting the fences and fixing the rides?
No, this is almost entirely new capacity expansion. This is about building new things to sell tickets for. And when you look at the breakdown they provided in the earnings commentary, it's a global blitz.
Let's take a tour around the world. Start in Florida, since that's the primary battleground with Universal.
Okay. Walt Disney World is getting what they're calling the largest expansion ever at the Magic Kingdom Park. They are finally, after years of rumors, building the Villain's Land.
Finally. People have been asking for that for 20 years. A whole land dedicated to the bad guys.
It's happening. It's in active construction. Plus, They're adding a Cars-themed area to Magic Kingdom, which is a direct shot at capturing the toddler demographic that might otherwise go to DreamWorks Land at Universal.
Smart. And what about the other parks?
Over at Hollywood Studios, they are building a Monsters, Inc. land, which fans believe will finally include the door coaster concept that's been rumored forever. And at Animal Kingdom, the Tropical Americas expansion is well underway, bringing Encanto and Indiana Jones to that park.
So they are aggressively filling out every single park to answer Universal's new gate.
Exactly. They are increasing capacity and attraction density across the board. Then you go international. To Paris. The World of Frozen Land is opening, which has been a huge, huge hit in Hong Kong. And the Lion King area is in development there as well.
Shanghai too, right?
Shanghai is getting a new Spider-Man attraction to follow up on the incredible success of their Zootopia land.
And there was a weird one on the list. Abu Dhabi. That's new.
Yes, and this is a fascinating tweak to their business model. It's a new resort in Abu Dhabi, but it's a partnership with a company called the Mural Group.
How does that differ from, say, building Disney World?
At Disney World, Disney owns it all. They put up the billions in capital to build it. It's on their balance sheet. In Abu Dhabi, Mural Group funds and builds the resort. Disney provides the creative design and operates it for a fee and a cut of the revenue.
So it's an asset-light model.
Exactly. It's a way for them to expand the brand's physical footprint into a new, wealthy market without fronting the billions in capital. It's high-margin revenue with very low capital risk.
Smart. It's a licensing play on a massive scale.
Precisely. But we can't talk about expansion without talking about the boats. The Disney Cruise Line.
The Cruise Line Blitz. This is, to me, perhaps the most aggressive part of their growth strategy. They are doubling the size of the fleet.
Doubling. It's incredible. They're going from 6 ships to 13 ships by 2031. They just recently launched the Disney Treasure and the Disney Destiny, but the big strategic play is the Disney Adventure.
That's the new megaship they bought and are refitting.
Yes. And it's home porting in Singapore starting next month in March 2026. This is their first ever dedicated access to the Asian cruise market.
That's huge. The Asian cruise market is massive and growing.
And it's underserved by premium Western brands.
Mm-hmm.
By putting a dedicated ship there, they aren't just relying on U.S. tourists flying to Asia. They are tapping directly into the rising wealth of Southeast Asia, Singapore, Malaysia, Indonesia, India.
Speaking of India, we need to touch on the pivot there, because for a long time, Disney was just getting crushed in India.
It was a massive headache. They inherited the Star India assets when they acquired Fox, and it was just bleeding money. They lost the IPL cricket rights, subscribers fled the streaming service, and it was a consistent drag on quarterly earnings.
So what did they do? Did they sell it off?
Something smarter.
Right.
They pivoted. Instead of trying to go it alone and keep losing money, they formed a massive joint venture with Reliance Industries.
That's the huge Indian conglomerate run by the Ambani family.
Massive. They merged Star India with Reliance's media arm, Viacom18. Disney now holds a 37% stake in the new combined entity.
So they give up control.
They give up majority control in order to stop the financial bleeding. It's a classic de-risking move. They can now leverage Reliance's scale, their political connections, their local power to dominate regional sports and entertainment.
But Disney doesn't have to shoulder 100% of the costs and the risk anymore.
Exactly. It's a classic risk mitigation move. Very Griffonomics.
I love it. Define the risk, then look at the reward. They define the risk as losing billions of dollars every year in India and decide to share that risk for a smaller piece of a much healthier pie.
It turns a persistent loss leader into a potential equity grower on their balance sheet.
Okay, let's bring it back to the U.S. and talk about sports. Because
Right.
something happened in January 2026, just last month, that I think went under the radar for the average person, but for the industry, it's seismic. Section 5, the sports evolution.
Seismic is absolutely the right word. This wasn't just another broadcast rights deal. This was an equity swap involving the most powerful sports league in the world, the NFL.
Break it down for us. This is a little complicated.
So in January 2026, the deal closed. The NFL acquired a 10% equity stake in ESPN.
The league now owns a piece of the network.
Yes, the implied valuation from the deal suggested the 10% slice was worth about $3 billion.
Okay, so the NFL gets a 10% ownership stake in ESPN. What did Disney get in return?
Disney got the broadcast rights to the NFL Network channel and, more importantly, NFL Red Zone. and they bolted that entire content library directly into ESPN's ecosystem.
That explains why my ESPN app suddenly has all this NFL Network stuff. And Red Zone is, I mean, it's arguably the most valuable sports product on a Sunday.
It's an addiction for football fans.
Right.
But look at the incentive structure now. The NFL has a direct financial interest in ESPN succeeding. If ESPN's profits go up, the value of the NFL's equity stake goes up.
It aligns them completely. It's a marriage, not a rental agreement.
It prevents the NFL from taking their content and going exclusively to, say, Amazon or Apple in the next rights negotiation. They are now partners. And there's a kicker. Disney has a buyback clause. Starting in July 2034, Disney has the right to buy back that NFL stake.
Interesting. So if it works out too well for the NFL, Disney can take it back.
For a negotiated price, yes, but the immediate impact is on Project Flagship. This is Disney's code name for the launch of ESPN Unlimited, the fully standalone direct-to-consumer streaming service.
This is the thing that finally lets you watch ESPN without a cable subscription.
Finally, we are moving away from the melting ice cube of the linear cable bundle toward a full digital sports platform. And by having the NFL as a partner and an owner, that very risky transition becomes much, much safer.
You mentioned the melting ice cube. That's a perfect segue to the risks, Section 6. Because everything we said so far sounds great. Profits are up. The expansion is huge. The AI stuff is cool. But what can go wrong?
A lot can still go wrong. And we have to start with that melting ice cube, the linear networks, ABC, FX, the cable channels.
I feel like we've been talking about the death of cable for a decade.
We have, but now the body's getting cold. The numbers are undeniable. The revenue in that division is essentially flat or declining. We're seeing -12% to -16% drops in comparable periods for linear ad revenue and affiliate fees. Cord cutting is not stopping. It persists.
So the cash cow of the 1990s and 2000s is officially dying.
It is dying. And the central question, the race for Disney stock is, can the growth in streaming and parks outpace the speed of the death of linear? That gap is the risk zone. If linear collapses faster than streaming profitability grows, the whole thesis falls apart and the stock crashes.
And then there is the other major risk, the one wearing a suit and tie, the Bob Iger question.
Succession, the ghost that haunts the company.
He's still there. It's 2026. He came back to save the company, but he can't stay forever. What's the latest?
He addressed this directly in the Q1 earnings call. He explicitly stated that the board's succession planning committee aims to name the next CEO by the end of 2026.
So we're in the final countdown. Less than a year to go.
We are. And you have to remember the Trian and Nelson Peltz proxy fight. Their entire argument was built on botched succession. They claimed the board didn't know how to pick a leader.
The Chapek disaster.
Exactly. If Disney screws this up again, if they pick the wrong person, or if the transition is messy like the Chapek handoff was, the stock will get hammered. The market has zero patience for governance failures at this company anymore.
Iger had an interesting quote about the successor on the call, didn't he?
He did. He said preserving the status quo would be a mistake for his successor. He said they must change and evolve, which is a bit ironic coming from the guy who built the status quo for 20 years. But he recognizes that the media landscape in 2030 will look nothing like it did in 2020.
So the risk is governance, and then there's simple execution risk, right? Can they actually hit that 10% streaming margin? Can they spend $60 billion without building a flop?
Exactly. $60 billion is a lot of risk capital. If the villain's land isn't a hit with guests, or if the Singapore cruise ship sails half empty, that destroys your return on invested capital, your ROIC. And the market will punish them for it.
So we've looked at the engines, the tech pivot, the massive expansion, and the very real risks. It's time for the verdict. Section 7. Is the magic financially restored?
Let's start with the hard numbers, the financial outlook. Management reaffirmed their guidance for double-digit adjusted EPS growth for fiscal year 2026 and fiscal year 2027.
Double-digit growth is very strong for a company of this size and maturity.
It's very strong. And if you look at the valuation, even after the pop this morning, the stock is trading below its 5-year historical averages for price to earnings and EBITDA. The market is still skeptical.
And skepticism creates opportunity for investors who've done the work.
It can. We also have the analysis from the Henry Fund, which we respect, citing an intrinsic value of around $134 a share, which implies significant upside from where it's trading now.
And they are actively returning capital to shareholders, which shows confidence.
A lot of it. There is a $7 billion stock repurchase plan active right now, and the dividend was just increased by 50%. These are not the actions of a management team that is worried about the future.
So, after all of our investigation, what is the Griffonomics conclusion?
The growth at all costs era is dead. The profitability and experience era is here. Disney has, in our view, successfully navigated the pivot from a confused, bleeding media giant to a high-margin physical and digital fortress. They've defined the risk-linear decline in streaming losses, and they have mitigated it with the experience moat and the streaming turnaround.
So is it a buy?
It is a high-conviction restoration buy. The pivot is real. The turnaround is not just a story anymore. The numbers in this Q1 2026 report prove it.
Risk defined, portfolio protected.
Precisely.
Before we sign off, I want to leave you, the listener, with one final thought to mull over. We talked about the OpenAI deal. We talked about fans making their own short videos of Mickey Mouse.
Yes, the democratization of storytelling.
Right. So here's the question. If I'm a fan and I use Disney's tool on their platform to make a 30-second clip of Mickey fighting Darth Vader, and for some reason that clip goes viral, millions of views, it becomes a meme. Who owns it?
That is the multi-billion-dollar legal and creative question.
Does Disney own my creativity because I use their brush and their character? Or do I own it? And at what point does the fan become the creator that Disney needs to hire or pay royalties to?
That is the blur. The line between consumer and studio is disappearing right before our eyes. And that philosophical shift might be the biggest disruption of all in the long run.
Something to think about. Check the show notes for the charts on those experiences margins. You really need to see the graph to believe how dominant that part of the business is.
It's stark. It tells the whole story on one page.
Thanks for listening. We'll catch you on the next deep dive.
Stay curious.
This is Griffonomics, signing off.